Eddie, it's great to have you. We are starting the second quarter, and we did see some losses to start Q2. What's your current pulse on the market?
So we thought it was a buy to dip opportunity last week. We got pretty aggressive in grossing up our equity exposure because we think this next quarter is going to continue to be strong. You know, we've kind of been range bound since the end of the first week of March. And the market's probably going to break out one way or another. We're betting that it's going to break out to the upside because it does look like the economy is actually accelerating. Now, of course, the inflation is going to probably stay hot for the foreseeable future. So, again, I think the Fed's best move is to actually not cut rates. But we'll have to wait and see what happens. But at the end of the day, I do think we still have a bullish setup for equities. And I think investors need to be positioned for inflation that's going to be sticky for the foreseeable future.
Talk to me about what data is informing your decision, Eddie. It sounds like to kind of double down or get more aggressive when it comes to stocks.
So generally, when you're seeing this acceleration happening, it's due to demand, and you're starting to see the global economies also pick up. You know, areas like India have been extremely strong. China is trying to come out of a trough that they've been in. And here domestically, I mean, we've had an economy that has just been extremely resilient. And when you're looking at what's happening to commodity prices as well, too, you know, I think it's a demand-driven issue. And you're seeing manufacturing has also bottomed as well, too. So it's really like a Goldilocks scenario from an equity perspective. Now, there is some big headwinds that we expect that we'll be dealing with towards the end of the year. And that's where inflation accelerates. And then the Fed may potentially have to raise rates. I don't think that's priced into the market at all. So our tactical moves are very short-term in nature because within the next 6 months, there could be an opportunity where we'll be looking to get out and really reducing risk if inflation actually accelerates.
Okay, interesting. So I would like to get your sense, Eddie, as to what are attractive buys for you in the market right now.
So if you believe inflation's here for a while, you want to own things like commodities. You want to own energy. We have energy exposure. We actually also have some small caps and mid caps. We believe the rally is going to broaden out, and the areas that haven't participated during the snapback last year should lead. So small caps we're in mid caps. We have had energy all year, which has been a great outperformer. And then, of course, you want your core holdings with a tilt towards growth. Growth and the technology side in combination with smalls, mids, and energy, we think will have a greatest opportunity of outperforming the S&P on a relative basis. So that's where we are concentrating our trades right now. And again, anything can change on any given day, but we think the setup is pretty bullish.
Are there any sectors or specific stocks, Eddie, that you might urge investors or our viewers, that is, to kind of stay away from as they perhaps look to reposition themselves during this second quarter?
One area that continues to struggle is the retailers. And look, when you see inflation getting sticky and actually potentially going up, it's going to hurt a lot of families. So that discretionary income can come down in areas, and you're looking at a lot of these retailers have really struggled. So I would stay away from the retailers, the consumer staples as well, too. We don't have any exposure, or very little exposure, I should say, because every client's portfolio is different, to staples, as well as anything interest rate sensitive. The real estate investment trusts have had some struggles here because rates are going to stay higher for longer. And you can see that in the way the 10-year Treasury and the 30-year Treasury has been acting. So interest rate sensitivity, you need to be cautious of. And this is why, again, tilting towards growth and commodities and energy and things that should do well when inflation is high or potentially going to get higher.
Mm-hmm. I'd like to get more of your take about rates, because last week we definitely saw some trepidation in the market, not because of how companies were performing per se, but because of what Fed officials had to say about the path forward for borrowing costs or interest rates. Do you think that the Fed delivers on its previous forecast of 3 rate cuts this year?
I do not. If they do, that'll be a very big policy mistake, in my opinion. And the reason why is they're trying to get inflation down to 2%. Inflation is a real problem. If you cut rates, that's actually extremely inflationary. So by cutting rates, you're basically saying that you're okay with inflation getting worse. And the biggest nightmare that we would have is if the Fed cuts rates too early and causes inflation to really get hot, and then they have to raise rates. This is why we firmly believe the best course of action is to actually do nothing. Things are fine right now with rates where they are. So why would you want to do something that's counterintuitive to what you're saying your policy mandate is? Now, my guess is they'll probably still cut, regardless of what my opinion is this summer. I don't see any way for us to get 3 cuts. I think the most we should see is 1.
Interesting. So how would you anticipate that the stock market would react to that?
So I think initially when you get the rate cut, you're going to see the market really accelerate. But that's going to be when we're closer to the end of the bull run from a short-term trade perspective. Because if you look back, rate cuts generally are not bullish for equities. That means something is wrong with the economy and it needs stimulus. And the biggest risk, again, to cutting rates is you see that reacceleration of inflation and then they have to raise rates, you would see a pretty sizable drop in the market. So I think the market is comfortable with where rates are right now. It's proven that. So why disrupt anything that is working?
Interesting. Now, in terms of where we end the year, it is an election year, and most of the data does say that election years are positive. Do you think investors should be factoring in an election into their own investment thesis for 2024?
I don't think they should. I really think you need to stick with the fundamentals and what the data is telling us, because I would argue we are in a time period that is unlike any other election year. When you take a look at the geopolitical issues, you look at the amount of debt, and you look at where we are right now in the business cycle and the pickle that the Fed is in right now, because, again, they've said they're going to cut rates, but how can you cut rates when inflation is where it's at right now? And so they're in a tough spot. So it'll be interesting to see if they get political pressure to cut rates. But I would focus on fundamentals, whether it's an election year or not.
Interesting. Now, in terms of where we end 2024, I know you mentioned you expect Q2 to be positive as well. We've seen businesses buying back stocks, raising their dividends. That certainly is some sign of confidence from corporate America. But perhaps we do see some trepidation in the second half as it relates to persistent inflation and perhaps fewer rate cuts than expected. Can the major indexes still end 2024 on a positive note?
They can end on a positive note as long as the Fed does not get too reckless in rate cuts. We are going to look at rate cuts as more of a bearish signal for the next 3 to 4 months out from that first cut. So if they don't cut rates in June or July, we're going to look at that as probably the setup is very strong even through the rest of the year. But if they cut rates in June, then more than likely by the fourth quarter, we're going to have some pretty sizable headwinds and look to pivot because inflation will accelerate. I mean, look at where energy prices are right now. That's not going to be fully in the CPI data that we get this week. So I'd rather them have some forward-looking data that they're looking at when they're making policy decisions, just the way we do when we're making investment decisions.
How would you grade Fed Chair Jerome Powell? It's tough, right, considering that he called inflation transitory in, what was that, September of 2021? And then by a new year, 4 months later in 2022, the Fed embarked on its most aggressive rate-rising policy in decades. And we had seen almost the Fed chair and the Fed kind of cave to what the market had wanted. The market wanted 6 rate cuts. Finally, at the end of last year, the Fed said we'll forecast 3. And now it seems like it might have to backtrack that a bit, too, and get its feet more steady on the ground.
So, look, to be fair to the Fed, because I know they get a lot of criticism, and I've criticized them at times, they're dealt a tough hand because they're trying to raise rates to get things down, and our government is printing money and debt at a reckless pace, in my opinion. So, again, that's working against the Fed. One thing I will say that the Fed has done a pretty good job of is telegraphing their moves and what they're going to do to try to not surprise the market. But they've had some missteps and they've had some good things that they've done. In order for us to get them a final grade, we have to see where they go towards this last part of the cycle, because I think this last mile of inflation is going to be the toughest. And if they're truly going to stick to their word that they're data dependent, then they're not going to cut rates. But if they cut rates early, we're going to see more than likely a resurgence of what we saw in the 70s, where they made the same policy mistake, and then they had to raise rates, and that was very, very detrimental to the market. So if they do that and inflation reaccelerates, then I will give them an F for doing that.
Eddie Gabor, co-founder and CEO of Key Advisors Wealth Management. Eddie, we appreciate it.